investor friends, I'm Michelle Markey, and if you're like me, you might be wondering if we're going to have a recession or not, because the US economy is somewhat of a mixed bag of both strong growth in terms of economic activity and business activity and people keeping their jobs for the most part, since we still have pretty low unemployment. But then there's also some warning signs like rising oil prices, and there was accelerated inflation in August. If you look at CPI figures for August saying 3.7% year over year increase compared to July's 3.2% increase. So even though the summer heated up, there could be signs that the overall economy may be cooling down. So the Federal Reserve is in a bit of a straitjacket right now, where they may not want to hike interest rates that much more because they want to see if the current Fed funds rate of 5.25% to 5.5% is doing its job to kind of neither spur growth nor slow down the economy too much. So some people are calling this a soft landing if the Fed can bring down inflation enough and also achieve this happy medium where there's still enough borrowing power for consumers and businesses while people are still keeping their jobs. So maybe they're still spending, and it's a fine balance. And I do not envy the jobs of the people at the Fed, because they get a lot of flack if they make the wrong call, but they don't get super appreciated if they make the right call. So trying to achieve this Goldilocks scenario for the American economy is such a tango that, it's a little dizzying, but I'll go through a few possibilities as to why the Wall Street Journal is saying that a soft landing for the Fed could prove to be elusive due to rising energy prices and also strong growth in the economy from what we saw over the summer. And I'll talk about some of my thoughts about all of this and how this might affect us as investors, even though we're looking at more of a macroeconomic take on all this. So if that all sounds interesting to you, I hope you'll hit that like button and subscribe, and let's get into what's going on with the economy. At the time I'm recording this video, the Federal Reserve in their FOMC meeting is set to meet between September 19 and 20, and then we'll see what their final decision is on rates. But most likely it's going to be what a lot of people are calling a pause, where the Fed is probably just going to keep doing a wait and see. But some people are warning that if the Fed keeps pausing for too long, that could potentially lead to some adverse consequences as well, because you don't want the economy to drag on from seeing the after effects of rate hikes. So rates are kind of high as they've been in 16 years, because the effective Fed funds rate is 5.33% as of August this year, whereas the last time it was anywhere near this rate, it was July 2007 at 5.26%. So we've had some of the highest rates that I've been able to see and take advantage of as a millennial. And it could be good if you're a saver, but not so great if you're trying to buy a house and have a mortgage. So there's kind of pros and cons to such high interest rates. And overall, it may mean that some businesses are not going to be as aggressive with expansion projects, because if they can't get cheaper loans, they might not have as much money coming in from just earnings to be able to afford new projects. Whereas when a lot of companies could take advantage of cheap debt, that could spur a lot of employee hiring and making lots of business activity that right now could be slowing down. So with such a strong effective Fed funds rate, the Fed is kind of seeing what will be the final effects of this, because just because it's at this rate right now doesn't mean we know what the full effects will be. And based on the summer having heated up, the Fed's preferred inflation indicator is actually the Personal Consumption Expenditures Index, which the PCE came in at 3% in June, and it was 3.3% in July. And the Fed prefers their target inflation amount to be at 2%. So clearly we're still way above the Fed's target. So they most likely see justification for keeping rates as high as they need to be for a while longer until inflation actually drops down below 2%. So it seems like we still have a ways to go, and maybe this fall will end up being the golden phase where perhaps the Fed could achieve their soft landing. But this is just a term that I think a lot of the media talks about as if it's something that could realistically be achieved, because historically chances are that a soft landing won't be achieved. Apparently, the only time when a soft landing was last achieved was in 1995. So based on that, it seems kind of unlikely that we'll get so lucky as to achieve this perfect soft landing thing, because back then, between 94 to 96, Fed Chair said that the interest rate they had hit was 6%, and they realized they were hiking too aggressively, so they notched it back down so that they wouldn't hamper the economy. And so the longer that the Fed's rates stay as high as they are, could be damaging to business activity in the coming months and into 2024. And also, Jamie Dimon, the CEO of JP Morgan Chase, recently said this September that if the Fed were to hike rates by 0.5 percentage point, that would significantly negatively affect business activity. And so based on that, it seems that it's a really delicate balancing act between, do we keep rates this high or for how much longer? And how will the economy look by next year? Because that's when some CEOs are a little bit concerned. Like the Clorox CEO believes that perhaps we might have a mild recession in the first half of 2024. And others also believe there could be a mild recession in some industries, like CVS might be worried about one. And also the video game company Take-Two believes they've already been in a recession for the last 18 months, coming from 2022 into this year. And others, like in apparel and Overstock.com, they believe that they've had excess inventory and have needed to clear it out. So across the board, it's not really consistent what's really going on. Some industries like food are doing well, like the Wendy's CEO believes that the consumer is pretty strong, and McDonald's said that even though the consumer is not as strong as they were in 2019, they're still spending quite a bit. So in spite of some of that, some people are still hitting up Cheesecake Factory and spending money, but others may not be going as lavishly in terms of getting new clothes, or maybe the rise in oil prices make someone think twice about going on a road trip. And the summer is winding down. And even though people still got to enjoy their summers, some people are saying that that may have been the last hurrah, that from now on, people are going to be a lot more mindful, because a lot of the stimulus people received are being spent away. And it'd be kind of surprising if a lot of people still have a lot of that money saved up and haven't spent it by now, or at least invested it, which is a smart thing to do if you got some stimulus money at the time. So between some of those things to keep in mind, it's sort of a mixed bag as far as what's going on with business activity. And then when it comes to people keeping their jobs, Apple has been retaining workers. So unlike some other technology companies, Apple's been trying to retain its workers more so. So that seems to be a trend also among small businesses, where workers are keeping their jobs because it was painful to let people go and painful to bring people back after all of the pandemic situation. So based on that, we could see employers being really reluctant to let people go, and also reluctant to hire people given the uncertainty on the economic horizon. And finally, you may be wondering if there's any chance that we'll actually have a recession by 2024. And the odds are high, actually, because this recession indicator known as the inverted yield curve is actually pointing to a good likelihood. And it's been mostly right through most of the times that it's kind of accompanied a recession, like the yield curve inverted back in 2019 before the pandemic 2020 recession. And while that was short-lived, it still maintained its pretty good record of being right. So if we look at the Treasury 10-year bond compared to the 2-year Treasury bond, we can see that that's been inverted since July of 2022. And that's not a great sign, but an even better sign of a likelihood of a recession is the 10-year and 3-month inverted yield curve. And that's been consistently inverted since October of 2022. And we can see that it's hit some pretty wide negative gaps. And it shouldn't make sense that you get a higher interest rates for lending your money only for 3 months to the government than, say, over a longer time horizon like 10 years. Technically, you should be trying to get more yield the longer you lend your money to the government, but it's flipped because some people are worried that we're going to have a recession, and that's why we're seeing this inverted yield curve, where for now you can make more money on shorter term bonds with the government than maybe you do with some longer term ones. So the interesting thing is that's pointing to some potential dark clouds in the sky as far as if we potentially get a recession in 2024. And based on the CME Group projections, it looks like maybe starting in June or July next year, there's a possibility that the Fed might actually cut their Fed funds rate from the current 5.25 to 5.5% down by a quarter to maybe between 5 to 5.25%. So that would be interesting if the Fed finally started reducing their interest rates, but they're probably not going to do it too soon because they don't want to be embarrassed. Like if they had hiked rates so high up until the summer, they're probably not going to budge by this September's meeting and suddenly cut them. So that's why the CME Group thinks it's a done deal and is saying that the Fed is going to keep it at the current range of 5.25% to 5%. But starting next summer, that could be a whole different ball game. So I'd keep tabs in the summer of 2024 to see if between maybe the July and September meeting, if the Fed starts cutting rates. So the CME Group economists are even projecting that the Fed will reduce rates to the 4.75 to 5% range by September of 2024. So in a year from now, rates could finally start going down by 0.5% or more, depending on, who knows if we have a stock market or financial crisis or some other geopolitical risks that are making markets scared and having the Fed to make moves to save the economy again. We'll just have to see what kind of happens, but it gives you some food for thought to try to be prepared and take advantage of higher interest rates that you can for now in your money market and savings accounts with a lot of high yield bank accounts that I've talked about. Like you could check out my video from August talking about some high yield bank accounts you can take advantage of now. And with the stock market, you just got to keep learning about companies you're interested in and trying to invest in them when they've been beaten down and hope that things will work out for the companies and that they can not only survive in a recession, but also thrive through them. So those are the main things that I hope you'll be on the lookout for. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be, keeping your job through no matter what happens in the coming year and having a good time in life, because no matter if we have a recession or not, you can't worry about it too much. So most of all, our health and our family are the most important. So keep those things in mind and you'll probably be a lot happier. Till next time.